Hello, this is Aaron Wissner of Local Future with Nicole Foss of, what do you call your organization? Foss Blog?
Well, it's called Applied Systems Thinking. The URL is
Systems Thinking.
foss.blog, but I call it Applied Systems Thinking.
And I'm in Michigan. Nicole is in New Zealand. It is December the 14th and December the 15th, respectively, 2020. Just previous to this, Nicole shared her perspective on the U.S. political situation with the current U.S. president and the president-elect. But now we're going to turn our attention to finance and investing. And I'll do a little bit of an intro, a 3 or 4 minute intro first. So if you are a follower of these channels, this channel, the Local Future channel, you might notice that we do finance stuff from time to time. In fact, earlier last week, I published an uncut meeting in the state of Michigan of the pension fund board. So in the state of Michigan, all the teachers and all the police officers and the prison guards and everybody has this huge pension fund. It has assets of about $60 billion, and that's up from about $45 billion in 2008, thereabouts. So this pension fund, I've attended a couple of the meetings. Every 3 months they'll have a meeting and they'll talk about, how are things going, and are we going to move into more of this or more of that, and how many people where are we getting our cash from, what are we selling to get the cash to pay the pension checks, and who's paying into the system. In Michigan's moved from a defined benefit system, which was right up until about 2003 to 2007, and now it's mostly defined contribution with some hybrid in between there. But I think pretty much anybody hired into that pension system right now is defined contribution, where you contribute your amount, and it's basically a 401k style system. So they were very optimistic, of course, all very optimistic that the fund has been growing at about 7% per year, actually closer to 8% per year for the past 10 years. They pulled out the statistics, the 1 year, 2 year, 5 year, 10 year. And they talked a little bit about, what happens if it goes down, the markets. And this past week, of course, in the United States, the Dow Jones Industrial Average went up to 30,000. Well, maybe it was 2 weeks ago, but that's a record. So a lot of people are concerned about these things because a lot of people are either pensioners or soon to be pensioners, or they have 401ks. People looking at those numbers, wondering where they should put their numbers. And so let's talk about that for basically 2021. And so let's talk about things like the housing market, pension funds, the stock market, Federal Reserve, interest rates. And let's just start from there, Nicole. What do you see, again, assuming that the US president-elect is properly elected and that things die down on the current president's whatever, and what in that future would you see as how things move forward finance-wise?
Well, to start with, I just need to make it clear that I actually don't think the next administration is going to have smooth sailing. So I'm going to sort of give you my spiel about this as if that were going to happen. I think there's a lot of chaos coming forward, as people who saw my previous video would know. But nevertheless, we can look at it as if the world was still normal and say, what are the trends that we would see? Well, the only reason that the stock market has gone up to the heights that it has is stock buybacks. And those stock buybacks were absolutely goosed with the payouts for COVID. So there were payouts for small businesses. Most of that actually went to large businesses anyway. Even the money that was designated for small businesses mostly went to larger businesses. So there's been very little bailout at the bottom. There's been a reasonable amount of bailout out further up, but the real money, and it's trillions of dollars, has gone to the biggest companies of all. Then they buy back their own stock. which pushes the price of that stock up, which means that the people who run those companies can grab huge bonuses because their bonuses are usually tied to stock prices. So this is an artificial high in the Dow. And what that level really says, it is artificial, but nevertheless, the stock market is an indicator of market sentiment, whether people are optimistic or pessimistic. So the fact that this has hit this kind of peak is a peak of wild optimism among the financial elite, this should be said. I mean, it's not a question of everybody being wildly optimistic, but the people who drive the stock market are wildly optimistic at the moment, because what they have come to believe is that they will never have to fail. They will never have to bear the consequences of their actions and their decisions.
I wonder if one of the reasons that it is highly optimistic is at this moment, the 14th of December 2020, you have the left party, the party on the left, which is optimistic about the president coming soon. And the ones on the right, they're optimistic about their current president maybe pulling one over. So there's kind of optimism on both sides.
There is that kind of optimism on all sides. Specifically, financial optimism tends to be among the elites, because the people at the bottom are hurting quite a lot right now. So they have a kind of desperate optimism that they are desperately hoping that their side will emerge victorious in this election. But that's optimism, but it's not the sort of thing that's necessarily driving the stock market, because these people are not directly invested in the stock market mostly. I mean, they're indirectly invested in it through people who hold their pension funds and things like that, but they're not the ones who are driving the prices at the moment. The prices are driven at the margins, and the prices are being driven by the extremely optimistic financial elite who've just been given at least $3 trillion unaccountable. So when the act was passed, there was a clause in it that said that the money that was paid out under this act, it had to be accounted for. There had to be a paper trail. You had to know where it went, who it went to, what the conditions were. The first thing that Donald Trump did when he passed this act was say, I am now going to ignore this provision. So all that money went out completely unaccountably. It will have gone into dark money holes all over the world. And so it's driving the US stock market, but it is also driving other things as well. But the fact remains that this is an artificial boom. There is absolutely nothing about the economic fundamentals that justifies a stock market at 30,000. Absolutely nothing. It's running on fumes, this stock market. And the more that the increase starts to just go exponential without even a breather of a movement downwards, the worse that is, because that's what happens at the peak of a bubble. Things start to just go smoothly upwards, and that's because people have thrown caution to the wind. They don't think there's any downside anymore. So they don't care what risk they take, because they think whatever risks they take, whatever losses they might incur, will be bailed out by the federal government and by the Fed. The Fed has been bailing out a lot of things. It has been taking unbelievable crap onto its balance sheet. The Fed is destroying the financial system while it does that. So this artificial low interest rate environment, we haven't seen negative yet, but I think we may well. But this artificially low interest rate environment is just encouraging people to take on masses of debt and not consider the consequences at all. So this applies to ordinary people too. So the large players are throwing caution to the wind and taking ridiculous risks, not worrying if they're going to lose. The smaller players are saying, oh, well, interest rates are so low, I'll just buy that bigger house. If they still have money, that is. So we're not talking the people at the bottom who probably have already spent their savings and are desperately in need of some stimulus money right now. I'm not talking about people who have no more economic freedom of action, but the people who still do are likely to be thinking, these interest rates are so low, I'll just buy a bigger house, I'll buy an extra car, I'll lock in that low interest rate, and then I'll be absolutely fine. And when you do that, people do that not thinking about how much they owe. All they are thinking about is the monthly payment. And if the monthly payment at very low rates of interest is manageable, then they will make the decision to proceed. What they are not seeing is that this is an extremely temporary situation. And when it breaks, it's going to break hard in the other direction. Then those interest rates will go through the roof, and so will those monthly payments. The amount of money they owe won't have changed, but the amount they have to pay on that every month will change. And
so it sounds like the people who are betting that the values of stock is going to go down and the market's going to go down might be very happy by what you are saying.
Well, yes, but the market can stay irrational for longer than you can stay solvent, as I believe Keynes said. So we don't know exactly when this will break. There are people who are shorting. There have been people who've been shorting for a while, but you can lose your shirt that way before the market actually turns. So even if you are right about what's going to happen, if you are too early, you can lose your shirt before you get to be right. So people have to be extremely careful. This is why I tell people, do not play this game. It is rigged against you. It is rigged against you by people who have inside information and who will have a much better ability to anticipate those turns because of that inside information than any ordinary people will. So if you try and be clever by knowing that the market's going to fall, you could still lose your shirt that way. The game is rigged against you. The markets are basically a very effective mechanism for separating ordinary people from their money. They've been that way for a very long time. People tend to buy high and sell low. This is a recipe for losing money absolutely all the time, because people they don't know when to get into something. Usually things don't even get on ordinary people's radar until the opportunity has passed. The bigger players will jump in at the first sign of the opportunity. They are the ones who are going to make the money. Ordinary people won't buy into that opportunity until much, much later in the cycle. And some of them won't buy into that until the very end of that upward move. So they will buy high. Even the skeptical ones, if it goes on for long enough, even skeptical people start to have this fear of missing out and start to buy in at the top. At the point where the most skeptical people have stopped being skeptical and have capitulated to the upward trend, that's when it's going to change. So it's coming, and it's not going to be very long. And then that trend will reverse, and a whole lot of people are going to lose an enormous amount of money. Not just ordinary people, but the big players will as well. Because what they're all going to do is try and hang on to the very last minute and then all get out of the exit at once. That doesn't work. What will end up happening is the market will close down. This happened in the Depression as well. The market closed, and then when it reopened, it immediately dropped lower. So people are going to see the market close and not be able to trade and be pretty darn sure that when it opens, it's going to open a hell of a lot lower. So as soon as it opens, you get another rush of selling where people are desperately trying to get out. And some people will try and buy back in because they've been trained to buy the dips. This is, they would call this in finance, trying to catch a falling knife. Don't do it. It's as painful as it sounds. So if you try and buy the dips when you're actually looking at the move into a bear market, you might get a bit of an upswing, but it's going to just keep going down like a lightning bolt. So it doesn't go down like this, it goes down in stages. And what you get in times like that is huge volatility, absolutely massive volatility. If you absolutely must bet on something, maybe you could bet on the VIX blowing out. So that's the fear index, basically. That's what happens in bear markets. It's not blowing out right now. In fact, it's low. People are not risk averse right now. They are incredibly complacent about risk, but they will be very afraid of risk very soon.
It's interesting that you mentioned the VIX, because in this State of Michigan Investment Board meeting, one of the staff, the employees of the state of Michigan who responds to the movements of this fund, said they were really watching the VIX quite closely earlier in 2020, and things seemed to, settle out. But he made a point to mention that was something that he was keeping a close eye on.
Oh,
now,
definitely. It's a measure of market sentiment. That's why it matters, because that's what tells you when you're getting to peaks and you're anticipating a trend change.
Well, and I imagine that there was effort at that time by either fiscal policy or monetary policy, or both, the government and the Fed, as far as making sure that volatility went away. I mean, there was the
Yeah, that's
large,
when they
as you,
threw $3 trillion at the market. And that's
right.
what stopped the decline in early 2020.
Well, and one wonders, how likely is it that there will be much more monetary policy here, as far as the federal government sending out these checks? There's been the rumor is, another $600 per taxpayer or something like that. But the unemployment benefits in the US, which were extended for, I don't remember what it was, 39 weeks or something, they're about to come to an end. And so is the
I believe they already
eviction,
have.
and so is the eviction moratorium in many places. So, one really wonders, where is the money going to be coming from that's going to be supporting these very high prices in various markets, the housing market, the stock market, the bonds, whatever. Because I mean, that's made a big difference, don't you think? The fact that there's $2 trillion flowing into the US economy from the federal government in 1 year.
Absolutely. That's exactly why the stock market is where it is now, and the housing market is still reasonably high. And this is what happened. They bailed things out again. So this was a monstrous bailout. It was absolutely enormous. It dwarfs anything that happened in the 2008, 2009 time. So this was absolutely gargantuan. But bailouts are only ever for the people at the top. So they keep things going long enough to get their own ducks in a row, so to speak, to get their own bailout, and then they let it drop. And that's what I think we're going to see. So they've secured their position. They're going to let everyone else hang. And I think, so assuming here, we are assuming that Biden has been inaugurated, that he is in power, and Trump is no longer on the scene. This isn't actually the way I think it's going to play out, but we're assuming that for the moment. So then we're looking at, does Mitch McConnell still control the Senate? Because if they lose the Georgia runoffs, then the answer to that is yes. He has already said he will prevent everything he possibly can, very much including any kind of stimulus, any kind of bailout. If Mitch McConnell controls the Senate, he will impose austerity on a scale never before seen in America, and there will be nothing anyone can do to prevent it. So he has already forced the Democrats to come to a deal at a much lower level of stimulus than they had wanted. He had been trying to hold out for a complete whitewashing of any kind of liability on behalf of corporations. So any kind of duty of care. The way the things stand at the moment, employers have a duty of care to their employees to not have industrial accidents and things. They have to take certain steps to protect their employees. There's employers' liability. And if they are negligent or reckless in the performance of that duty, then there is legal liability. In civil law, it's not normally criminal, but there would be damages to be paid in civil law if they have been negligent or reckless as to the safety of their employees. Now, COVID brought in a whole lot of things that would have increased that duty of care enormously. Employers would have had to put in ventilation systems, perhaps run short undermanned shifts if that's possible in whatever business they're running, to have fewer people, more spaced out, better ventilated spaces, maybe put perspex cages around certain people the way you see in grocery stores now, barriers between people to try and stop the spread. There are a lot of things that employers would have had to do in order to meet that duty of care. So McConnell was trying to get that duty of care removed, even in the cases of negligence and recklessness. In other words, he was holding the whole stimulus bill hostage over trying to give employers a completely free pass to do absolutely nothing to protect their employees from COVID, while still requiring them to turn up to work. And if they get sick, the company washes its hands of them. So that was what McConnell was trying to push for. I haven't looked at exactly the details of the deal that has gone through at the moment. So I can't comment on exactly what has come out of that agreement, but that was the setup for it, that he was going for removing any kind of duty of care for employers, and he was trying to whittle down the amount that would be given to people. And they have succeeded. I have not yet seen whether he succeeded in getting through this employer removal of liability. I certainly hope not. I don't think the Democrats would ever agree to that, because it would just give employers absolute carte blanche to do whatever they want and take no safety measures whatsoever for COVID or anything else. So if you look back in history at what things looked like when employers didn't have a duty of care to their employees, I'm thinking, say, miners in Victorian England who had to buy all their own safety equipment and their own candles, and if anything happened to them, there was no compensation, nothing. They had to look after their own safety in whatever way they could conceivably afford to do it. It was a very dangerous job. The death rate it was horrendous, and there was no duty of care whatsoever for employers. So we're talking Dickensian levels of that kind of capitalism, where all duties of care are abandoned and people are just exploited in the worst possible way. That was what Mitch McConnell was trying to bring in. So if Mitch McConnell controls the Senate, it will be austerity, and there will be no bailouts for people. Ordinary people are going to find themselves part of a greatly expanded proletariat very, very quickly. So a recent example of this was Argentina in 2001. So they had a financial crisis. The banks collapsed. Everybody's savings were gone. The savings were erased, but the debts remained. And of course, people no longer had any means to pay those debts. So all their assets were confiscated. And the middle class ended up living in shantytowns in Buenos Aires because they couldn't afford anything else. But the rich got their bailouts. So you ended up with an enormous disparity between the haves and the have-nots. On top of the large disparity that already existed, it became very, very much worse in that period. It basically destroyed the middle class. So then you had a plutocracy where you had all the money controlled in the hands of the very, very few, and the vast majority had absolutely nothing. Now, because Argentina was the only country that went over the wall at that time, there was still the rest of the world economy standing. And so the people at the top were able to just still continue in everything that they'd been doing, and they could draw on funds from overseas. And so they weren't really harmed at that time. The danger this time is that more places are going to go over the edge at the same time. And not just countries of the global periphery this time, but countries at the global center, the US and Europe specifically. And this is going to have a very, very much larger impact. So if you think about the middle class in the US and Europe, people take their middle class status for granted, even although in recent years they've had to dig themselves deeper and deeper and deeper into debt to maintain it. They still believe that they are middle class, and they still believe that those debts are manageable, that they'll be able to pay them off over time, and they'll be able to retire and enjoy life. I'm sorry, it's not going to happen. None of that is going to happen. Even under the best possible set of assumptions for this next administration, there won't be anything they can do to prevent that. Now, if the Democrats win both Georgia runoffs, which I think is possible, perhaps unlikely, but possible, then Mitch McConnell would not control the Senate for the next 2 years, and in which case this scenario gets delayed by 2 years. But because I think it's extremely likely that he will will resume control of the Senate, he or someone very much like him will resume the control of the Senate in 2022, I really only see it as a postponement. But if that does happen, that would be a very useful postponement, because it might give people a chance to extract some of what they have out of the system before it crashes on them. And then you get some capital at the bottom of the pyramid. It will be unevenly distributed, extremely unevenly distributed. I would then say to those people who manage to get hold of some capital that they not regard it as something that they should just say, I'm all right, Jack, over, but they should regard it as seed capital for community building at the local level. And this is something that people are mostly not inclined to do, because that sounds a whole lot like socialism, and Americans just don't like that sort of thing. It isn't actually socialism at all, because socialism refers to what the government is doing, not what individuals are doing. But I'm suggesting that people consider pooling resources. If you do manage to get something out of the system, pool resources with, at the very least, as wide an extended family as you can, preferably a friend circle, a community. Because if you can keep some capital at the base of the pyramid, then the collapse doesn't have to go so far, because it gives people more freedom of action, more capacity to act at the local level. So I think getting some resources out will be important. However, having said that, doing that will crash the system even faster. So, because there's only a certain amount that is going to come out of a collapsing Ponzi scheme. There's nothing anyone can do to increase the amount that is going to come out. But you can redistribute where it ends up. If ordinary people know that this is the risk they are facing, they have the opportunity to extract resources from the system and get hold of it under their own control. And then they have the capacity to do some community building. And it will absolutely be in their own interests long-term to share, because in doing so, they make their continued existence in other people's interests. And there's no better security you can buy for yourself than that. Because if you extract resources and then sit on them and say, I'm all right, Jack, your continued existence will not be in the interests of other people necessarily. They may well regard you as someone who's just, sitting in their own little area and saying, no, I don't care what happens outside of this. And there are more of them than there are of you. So you don't really want a mob at your gates thinking that you are one of the people who selfishly hoarded a huge amount of wealth when everybody else had nothing. So I think it's very much in people's interests to share. And at the very least, share within extended families. If people only did that, that would make an enormous difference. Because what you have now is the older generation tends to have all the assets. The younger generation tends to have all the debts. But in the future, we are not going to have the same access to healthcare. Healthcare is busy being bankrupted right now by this virus. So people can't afford to pay for the treatment they're getting. Doctors are taking pay cuts. Hospitals are going bankrupt already. So the older people who are on the verge of needing more medical care are probably not going to get what they thought they were going to get. They're not going to get the pensions they thought they were going to get either. They are going to need to be looked after. The younger people have so much debt that they're drowning in it. They don't have any assets. It's hard enough to find a job just to support themselves. And trying to support their parents is going to be even more difficult under that scenario. But if you spread the assets around the family, the older generation can pay off some of the younger generation's debts. Then the younger generation can look after the older generation in their old age. It won't be quite the same as having high-tech healthcare, but it would be a hell of a lot better than nothing. So this is exactly what I suggest to people to do. If you can cash out pension funds that won't be there if you leave them, get hold of whatever you can get while you still can, even if you have to pay a tax penalty for it, at least you get something, which is probably not what you're going to get if you stay in the system. Then you have the ability to secure your extended family. And I would also suggest that people consolidate with their extended family in one property if they possibly can. People are very spread out at the moment. Often you get one person or a very small nuclear family or just a couple or retired couples in a house. And the retired couples often are living in quite large houses that were paid off decades ago. Well, if they invite their extended family to come and share that with them, everyone gets a bit less privacy. But though, if you can sell off those other properties that are probably indebted, get the equity out, bring it back into the extended family, look after it under your own control, you can have a situation where you've got a whole group of people, they're related, they have an interest in looking after each other, they're going to try and help each other in whatever way they can, and they may be carrying no debt. That is the best scenario you could possibly position yourself in. But it's difficult. This is not something Americans think of naturally. The whole extended family thing does not come naturally to the American mind. And to many others as well. I'm not just trying to pick on Americans here, but Americans are more individualistic than a lot of other places. So, and they haven't got a tradition of extended family living together. They used to, but that's been broken a very long time ago. So it doesn't tend to be the way they think. So the result of that individualism is that resources are spread too widely, and the only way those assets have been able to be purchased that widely is through debt. You do not want to be carrying debt under these circumstances. The interest rates will spike at some point. And at that point, you will not be able to afford to carry that debt. Those indebted properties will probably be foreclosed. So the opportunity to extract equity will be gone. I suggest people extract whatever equity they can, consolidate their families in one place, if at all possible. It isn't always possible, but if it is, then that's what I would recommend, because that gets you out of multiple traps all at once. And if you have enough assets to make it broader than extended family, then that's even better. But you have to be careful. You really want to trust people. If you're going to pool resources, you want to build a basis of trust. So having people come together who already trust each other, that really helps, because you don't want to give this sort of way forward a bad name by, say, people sharing resources with the younger generation, and then say maybe the younger generation just runs off with it or something. It's happened before. Money causes a whole lot of arguments in families. So you really want to know that you can trust the people that you're sharing your resources with to be on the same page, to truly understand that you must share, that this absolutely has to be the way forward, and probably for quite a few years. But if people do that, there are so many traps they can get themselves out of. I mean, if you can all be living in a reasonable sized property, even if you have to squeeze into it and you don't have a lot of personal space or privacy, if it is something where there is no debt, and you can all look after each other, and you've managed to get enough equity out that you have some cash on hand, then you will ride this out an awful lot easier than most people. Part of the problem with trying to consolidate is, some older people have decided to sell the house, buy an RV, travel around the country, do whatever they want. It's not going to work if they don't still have a property that's left for people to consolidate in. Although it would be possible if there are a lot of smaller properties, people could sell all the smaller properties and buy a bigger one. Of course, this will also tank the housing market if people do that. The problem is everything that people try to do to protect themselves at this point will bring the financial crisis on quicker. But if you don't do it, then you will just lose along with everybody else. There is no way that everyone can get what they have out of the system, because we have an enormous crisis of under-collateralization. That's what bubbles do. They create enormous amounts of debt, all grounded on the same small pool of assets. So all backed by that same small pool of assets. When you've got this many assets and like this much debt on those assets, that's not going to work. Those debts will not be paid back, and assets are going to be confiscated. And not necessarily by people who really have a right to them, but by whoever can get away with it. So this is where you have the whole musical chairs analogy that I've used so often. So you have a game of musical chairs, and there's about one chair for every 100 people playing the game. It could even be worse than that by now. I'm just spitballing here as to what the ratio could be. And while the music is playing, we're all up and dancing, and we don't realize that at some point the music is going to stop and the great asset grab will begin. People will grab a chair. And what's happening is that's already going on. The people who know that the music is going to stop, even although it hasn't stopped yet, the people who know that it's going to are already grabbing the chairs. By the time the music stops, there might not be any chairs left at all. So it could be even worse than just musical chairs, where the chairs are all there till the end and then everybody just has to grab for them. The chairs might even be gone before the music stops. And I think that's exactly what we're seeing now. And so my view in the past was that a financial crisis would probably be the beginning, would be the first thing that we would see. What has been interesting is that what has actually happened first is this chair grabbing before the music has even stopped. So the rise of the far right is all part of that. It's trying to dismantle the system in their own favor before a financial crisis actually hits, before anyone who isn't part of the elite even really has much of a chance to see that the music is going to stop. So we're actually seeing the human reaction to what is coming before it's even happened. And this is very interesting to me. So we're seeing all this political upheaval. This is happening because they know the music is going to stop and they have to get their chairs before it does. So that's exactly what's playing out right now. We're seeing all this political upheaval. This is the elite sorting themselves out. They are going to want to build large armed compounds and things to live in. I have said before that what they're going to be building is actually gilded prisons, because yes, during the first stage of a financial crisis, the inequality gets worse as the powers that be buy up everyone else's assets for pennies on the dollar. You get even worse inequality than you had at the peak of the bubble, which was bad enough in its own right. But at some point, when people have nothing left to lose, they will lose it. And then these armed compounds will be overrun. So they're not buying themselves safety. They might be buying themselves the perception of safety, but it isn't going to work because eventually they will fall too. But this is a pretty drastic scenario that I'm painting. And there are lots of things that are part of this. So interest rates, stock market, mortgages, housing, all these things are part of what's going to unfold in the next financial crisis. We saw the beginnings of that in 2008. It was bailed out. So it didn't go as far as it otherwise would have done at that time. But the situation, that just meant the situation could get worse. And it's now got so much worse that it's really not possible to bail it out anymore. The losses are going to be so gargantuan that absolutely no one on the face of the earth, individual or organization, has the capacity to bail this out. So, have the elites having got their themselves more or less sorted out, they're going to let it drop, I think. And then that's when you're going to see the real financial crisis. And there won't be a bailout this time. It wouldn't be possible even if they wanted to, although they would be able to mitigate the harm. I don't think they'll even do that. And I think that's just absolutely tragic. So I think if one is carrying a mortgage, has a house with a mortgage, think hard about how much you really want to own that home, or whether there's any way you can pay that mortgage off early. So some people will be carrying a mortgage while having a big stock portfolio, for instance. And they might say, I'm making a better return on my stock market portfolio than the interest I'm paying on my mortgage, so I'm winning. That's a recipe for losing both. They should be cashing out those stocks and paying off that mortgage so that they had a home with no debt. That would be the safe way, because if you stay invested in a Ponzi scheme, which is what the stock market is at the moment, you're going to lose the interest and the capital. And if you were carrying debt on your home, the odds are that will be foreclosed as well. Even if your mortgage is small, and in fact, especially if your mortgage is relatively small, this is a concern, because when banks repossess properties, there's not a lot of point in starting with the ones where there's nothing to be gained anyway, because there was maybe a 95% mortgage on it. Or maybe even if the housing market has started to seriously fall, maybe the mortgage is now 150% of the value of the house. You're not going to get anything by repossessing those. So they'll go after the ones with the smaller mortgages. And they can do this whether or not you have ever missed a payment. They will simply rewrite the rules retroactively if necessary, and they will claim people's properties. Because if you have a small mortgage, say about a 20% mortgage, 80% paid off, well, if they foreclose on your house and claim it, well, then they can probably make a profit on what they sell it for. Whereas if you had a massive mortgage, they couldn't. So any mortgage is a threat. Now, some people may be able to continue to carry a mortgage, but they would have to be able to live on a fraction of what they currently live on, because they're going to have to be able, not just be able to pay that mortgage, sort of, but be able to pay it incredibly easily. Like if it's a tiny fraction of your outgoings and you've already secured all your assets, you might be able to continue carrying a mortgage. I don't think it's a good idea, but you might be able to. Alternatively, if you, say, bought a property with a bunch of other people, all of whom have jobs, and you're pooling your resources and working together, you collectively may be able to cope with a mortgage because you had so many income streams, and it really helps if they're relatively depression-proof income streams. But if you've got income streams that are coming in, you may be able to sustain carrying that mortgage. So the scenario where you might want to do that is if you had to take a mortgage to get something that really would be a homestead. So something, a piece of property that would support multiple families. Then it might be worth taking on some debt in order to do that if you reckon you have enough depression-proof income streams to not just have that property repossessed at some point in the future. So there are a whole bunch of scenarios that depend on individual factors like that. But in general terms, the advice is don't carry debt of any kind if you can possibly avoid it. So renting is not as bad an idea as people think. I mean, yes, there's a cost to renting. It can be a bit humiliating. You can find you have a bad landlord. Your landlord might go bankrupt. You might have to move more often than you want. You might not be able to do some of the preparation type things that you would want to do if you don't actually own the property. But still, renting is paying someone else a fee to take the property price risk for you. And that is not a bad bet under these circumstances, because when the markets start to crash, property prices are going to fall. Not necessarily immediately, because what happens first is the market goes illiquid. So you just get no buying and selling going on at all, because you get a gap between what buyers will accept and what sellers will offer, or what sellers will accept and buyers will offer. And when you have that gap, the market is illiquid because no one will make a bargain. At some point, people will make a bargain for whatever reason. They have to sell, they're desperate. They will make a bargain at a lower price. And then this is price discovery. You have now just lowered the price of that class of assets for everyone who owns it, not just the people who made the initial bargain, but everyone who owns that class of assets now owns an asset that is worth less than it was thanks to price discovery. So you only need a few sales at the margins at a lower price to kick in the next phase of the housing market decline. And the things will decline. Buyers will say, prices seem to be falling. I'll just wait. I don't need to buy right now. I'll just wait a while because prices are coming down. And then you get another round of the market being illiquid. And then you get the rinse and repeat, the same scenario. Some people will have to sell at that price, and you get price discovery at an even lower level. So housing markets tend to take several years to bottom out, unlike financial assets, which can bottom out very quickly because they don't really exist. They're entirely virtual. So the crash in terms of financial assets can be very much quicker than the crash in terms of the price of physical assets. So these are the sorts of things we really need to think about. The other aspect is going to be interest rates. Now, my longer term projection for that is sky high interest rates, but not yet. What I think they will do first is allow interest rates to go negative. So I wrote an essay on this that I can send to Aaron and he can attach to this. And it was basically called Negative Interest Rates and the War on Cash. So what happens when interest rates go negative, there's no longer any reason for people to keep their money in the bank, because not only will they not be earning interest, they will have to pay for the privilege of keeping money in the bank. At that point, that's called the zero lower bound. When you hit the zero lower bound, there is no incentive for people to keep money in the banking system. So the banking system has certain risks involved with it. So more people will say, I think I'll just look after my own money, thank you. And then they crash the banking system by withdrawing their funds. So in order to get around the zero lower bound, you have to prevent people from being able to do that. So you create a cashless society, perhaps. You force everyone into an electronic banking system, which is then entirely controlled from the center. They will have total control of your money. They will know everything you do with it, everything you spend. There will be no way to spend anything that does not go through that system and cannot be monitored and surveilled. So this is how you get to financial totalitarianism. You get rid of cash, then you drop the interest rates below the zero lower bound, having shut the escape hatch in the meantime. Then you can have interest rates negative. This will be to try and spur investment, to say that we will pay you to borrow and invest. This is what that would amount to, telling the larger players, we will pay you to borrow and invest. I don't think it will work. I think they will be pushing on a piece of string, which is another Keynesianism. So you can pull on a piece of string and have an effect, but pushing on a piece of string does very little of anything. So that's what happens when you cut interest rates to the point where you can't go any lower without going negative. You are pushing on a piece of string. This is the liquidity trap. So the way to get out of the liquidity trap is to shut the escape hatch, get rid of cash, force everyone into the electronic banking system. And once you've done that, then you can send the interest rates through the roof. And everyone will be trapped. People will be carrying a huge amount of debt. They won't be able to pay that debt off. Because just as in Argentina, the savings will go away, the debts will remain. And this is how you beggar the middle class. So, and remember, I'm describing this scenario, which sounds pretty apocalyptic. And this is your best case scenario, because this assumes that Joe Biden is inaugurated and he gets to more or less function as an American government in the form that people are used to. I don't believe that assumption to be accurate. I don't believe that that's the way it's going to play out. So I'm describing the best case scenario here. This is another thing that people absolutely have to be aware of. And all these pension funds, for instance, people think they're going to get a pension. The assumption is that the rate of return will be 8-10% a year, maybe. Usually it's about 8%. It's going to be negative. There's going to be nothing to pay out to people. It's so profoundly sad that people believe that returns in the stock market are guaranteed forever. They're absolutely not. And in a crash, those returns are going to collapse. Returns on stocks, returns on bonds, anything financial, people are not going to, those are not going to be assets. People are not going to be able to claim a return based on the ownership of those assets in perpetuity. So living off the interest, basically, that's what it amounts to. And that's not going to be possible. So I would say to anyone who's in a position to cash out their pension early, I would do it. If I was in that position, that's certainly what I would do. I'm far too young to retire. Well, far too young, perhaps. I'm 55. So I'm not retirement age. So and that is not something that I can do anyway. But if I was in a position to do that, I would claim that early, because I think whatever you get now is going to be worth more than whatever you get in the future. What people have tended to do with pensions, as far as I understand it, is you get a lump sum and then you buy an annuity, and the annuity is a promise to pay you a return on the money that you've just given the money managers to manage for you. So do you really trust those money managers to know how to get an 8% return? Nobody's going to get an 8% return, no matter how smart they are. It's just not going to be a possibility. So those annuities will fail because the assets that they're based on will fail, and there won't be any return on those assets. So your lump sum is all you're going to get. I would see if there's any way to not take out an annuity, because that's a bet on the long term that isn't going to play out the way that annuity is founded on. So don't go for annuities if you can possibly avoid them. Go for lump sums if you have any opportunity to do so. I would suggest doing it earlier if you can. I don't know what the rules are around being able to do that early in America. I imagine it varies a great deal by money management company and state and all sorts. But if you can get hold of your assets, anything that you own that is under your own control, you might get to keep. Anything that's embedded in the system, probably not, especially if you're an ordinary person. And if you're Bill Gates, well, that's different. Who is Bill Gates other than him? There are very few in that situation. Most people are going to be in a position where if something is embedded in the system, it's not going to be there for them when they need it. So whatever you can get out of the system, I would do that. This will cause the system to crash sooner than it otherwise would have if enough people do it. I don't think enough people will do it. So whatever a few people do would not make an enormous difference to the system as a whole. But your choice really is, it's not between take my money out and crash the system or leave my money in and save the system. That's not the choice. The choice is take my money out and I may be contributing to hastening the crash of the system, or leave my money in and lose it all. That's your choice. So this is why I'm giving people this advice, because we're just moving into very, very dangerous times. And there's going to be a collapse of the housing market. There's absolutely going to be a collapse of commercial property. That's already beginning. We're seeing malls going under, and there's going to be enormous amounts of empty real estate. I think they need to start repurposing those empty malls for something. There are few now. There are going to be many, many more in the future. And that real estate exists. It might as well be repurposed to do something useful rather than simply to be demolished. It was actually one of the things that the powers that be typically do when there's a housing market crash is they demolish the surplus supply. Even when there are homeless people, people who are, 10 people living in a 2-bedroom apartment, and those homes would be absolutely suitable, they don't give homes to homeless people. That would amount to a bailout for the bottom, and bailouts are never, ever for the bottom of the pyramid. What they will do is demolish them to reduce the supply to try and keep prices higher. So there are just so many ways this is going to play out that are not going to benefit the people at the bottom. The people at the bottom at this point have to understand how the system works and what it's trying to do to them early enough to maybe be able to do something about it. Because if they can do something about it, they may be able to protect themselves. But no one from on high will be telling you this. No one will help you do it. In fact, they'll probably call you insane and try and talk you out of it, because it's in their interests for you not to do this, of course, but it is in your interests to understand the system and understand how to protect yourself against what's about to happen. And I just don't know how much more forcefully I can say that this is a very risky situation. And people are wearing rose-tinted glasses at the moment. They always do at tops. That's exactly why we have a top, because it's a peak of optimism. Market sentiment is what to look for. And sentiment isn't just about markets. Sentiment is about everything. When you have this upwelling of optimism, then you are driving asset prices upwards. You create a self-fulfilling prophecy to the upside, but it doesn't continue forever. And people are most optimistic right at the point where the trend change is about to happen. So when you see widespread optimism and people thinking it's all going to be all right, that's exactly when to expect the trend to change in the other direction. So, and this is coming, and I really, really would like to see people protect themselves. There's not probably very much time left to do it. And I was warning about this, 10 years ago, and if they hadn't bailed out the crisis at that time, then we would have had this scenario unfold 10 years ago. Because they did bail it out, they got 10 more years for the elites to sort out their affairs. Unfortunately, 10 years ago would still have been the best time to be preparing for this sort of thing, because if people had actually spent the last 10 years preparing for it, they could probably be in an incredibly secure position right now. Unfortunately, very few people did spend that time preparing for it. So now the warnings have to be even more stark, because the time frame is going to be shorter. And it takes time to extract yourself from embedded financial positions. It really does. And I don't know how many people are going to have time to do that now. Given that there's going to be a lot of other upheaval, there's all the virus and everything to deal with, it's hard to be marketing things if people are, you don't necessarily want people to be just coming in and out of your house when you don't know if they might be sick, and they won't wear a mask. It makes it difficult to get out of the scenario that I'm painting. It's much harder now than it would have been before. But if there is any way to do it, I really do suggest that people look to protecting themselves. I don't think there's very much time. And I think the rosy scenario that people are seeing right now is absolutely a trap. It's a very, very dangerous situation that not just America, but the whole world is in right now. I mean, here in New Zealand, we have a gargantuan housing bubble. This is one of the least affordable places in the world to live right now. And this is already beggaring a lot of the population. People are living in their cars. They can't afford homes. They're massively indebted. So this is going to be global. Australia is the same. Canada is the same. Canada has one of the largest housing bubbles on the face of the earth. Scandinavia as well. All the countries that more or less got away with it in 2008, they got away with it because they were all exporters, resource exporters or manufacturer exporters, and they managed to keep things going in their country because of the fact that there was a huge bubble in commodities at the time. They were getting incredibly high prices for the commodities that they were selling. But these countries, they've got now even larger housing bubbles than they had in 2008. And they're even more complacent because they thought we got away with it last time. We're just special and we'll get away with it this time. They won't. They absolutely won't. So all these countries that people are currently looking to as sort of paragons of exactly what you would want to emulate, they're all about to take a fall. And I would suggest to people, look back, 10, 11 years. What countries were people holding up as the examples that, everyone should be like these countries because they've obviously got everything right? Iceland, Ireland, what happened to them next? They immediately went over the edge. And so there are a lot of countries that are going to go over the edge where people are not expecting this to happen. Things have been good for so long in places like Australia and Canada that nobody is expecting this sort of thing to happen, which is exactly the time it is going to happen, because maximum complacency is exactly when trends reverse. And there's so much that people could be doing. I really, really hope they do. And I'm not sure that's much more that I can say about where these trends are going, but it's going to be tough. And I just wish everyone the absolute best of luck in being able to navigate this. I really do. But it is going to be hard. It is not going to be business as usual. And there's going to be enormous amounts of upheaval in finance, in the physical economy, in politics. There are so many things poised to hit the fan right now that be prepared. If you are psychologically prepared, that's half the battle, because it doesn't come as a massive shock. Like if people who are totally complacent suddenly have the rug pulled out from under their feet, and every single assumption they built their lives on is invalidated all at once, what are they going to do then? Well, they're going to panic and stand there like deer in the headlights and collapse, because they won't have any capacity to act anymore. They'll have lost everything. This is an avoidable situation. I would really, really like to see people save themselves if they possibly can. But the first step is taking off the rose-tinted glasses and saying, okay, there's a bad time coming. This is going to be hard times, probably for at least 10 years. It's going to be hard times. What do I have to do to protect myself and my family from hard times? And if you're even thinking that way, even for people who haven't had a chance to actually do much to protect themselves and to implement a plan to protect themselves, just the understanding that hard times are coming and that you have to protect yourself is the first step in that direction, because then people won't necessarily be deer in the headlights. And the further you can go towards implementing a plan for protecting yourself, the better. But even if you can't implement it, just being aware that things are going to happen is a step in the right direction. So I'm just asking people to take off the rose-colored glasses and actually try and engage with reality. There are an enormous number of people who no longer live in the real world. And the right-wing media ecosystem has guaranteed that their supporters don't live in the real world for a long time. But I don't think the other side is living in the real world either. I mean, at least the other side still believes in evidence and rationality and law and things like that. But believing in those things won't mean that they continue to exist. They be believed in for longer than they will exist. And that's dangerous, because then people make assumptions that there will be backstops, that there will be institutional protection. And I don't think those things will be there when people want to rely on them. So I think both sides are delusional at this point. And the sooner people wake up, especially, please, the people who are evidence-based and reality-based, more or less, the people who actually believe in the rule of law and good governance, and if they wake up, that would be wonderful. They're the ones who really need to take off the rose-tinted glasses. The people who've fallen for the right-wing media ecosystem, unfortunately, I think there's nothing you can do to make them take off their rose-tinted glasses. They're going to need full cult deprogramming, and that's not something that any of us are capable of providing to them. So there's nothing I can do to help them if they don't first step out of that complete unreality that they're currently living in. So I'm pitching my message to the people who I think might listen, the people who do still regard evidence as meaningful, who are perhaps prepared to see that the trend change might be coming and do something about it. So if the message reaches you, then please bear it in mind. That's really all I can offer at this point.
All right. Well, thank you so much again, Nicole, for your time this week.
No problem.
There are many people that greatly appreciate it. And if you are one of those people, please do a thumbs up and leave a little comment. Feel free to share this video and subscribe to the channel. We will not be probably together for a few weeks, but maybe the first week.
I can probably do next week. Do next week, but probably not for a couple of weeks or so after that.
Okay, that sounds good. So thank you so much again, Nicole. I hope all is well with you over the end of December holidays, and hopefully we'll see you next week. Bye-bye.
Okay. Bye.